Candlestick signals make identifying where the buying and selling is occurring much more accurate than any other trading uh, technique. Note how we had a big bullish uh, hammer type signal right here at the 200-day moving average after hard selling last week. Indecisive trading. Then any bullish trading was likely to take you to a very likely target, the T-line. Once we started covering short positions and or going long, the final criteria for a reversal was based upon confirmation that they were going to continue above the T-line. Yesterday, however, you saw that it did a doji right here on the T-line, making today's trading very simple. The simple doji rule told us that the trend was going to move in the direction of how they opened it this morning. The fact that the pre-market futures were showing it was going to open lower told us we could get ready to start going short, or basically any long positions that were failing should be closed out immediately. The S&P 500 provided that same type of information. Big hammer signal right here at the 200. Indecisive trading. Kicker type signal. And where did it fail? Right smack dab at the T-line. The doji of yesterday was, again, that final criteria telling us if this was a reversal uptrend, we should see it. The markets open positive and trade positive today. If it was failing at the T-line, we would witness in the lower open, which it did. Now we've got the next analysis that this may be a bearish J-hook pattern with a wave 1, wave 2, starting wave 3 to the downside, meaning if they come back down through this level, we've got the prospects of another move of this same magnitude. That same criteria can be utilized for individual stock prices or any trading entity that has fear and greed in it. Our long position of Helix, HLX, was based upon it staying above the T-line, but the same scenario was required. It needed to open positive today to stay long. If it opened lower, we closed out the position immediately, with that simple doji rule saying that if it opened lower, the prospects were pretty strong that it was going to trade lower. Knowing the prospects of different candlestick signals and patterns also allowed us to get ready to go short on weakness today based upon a very simple trend rule. This is what we call the blue ice failure, named by my late friend Dave Elliott of Wall Street Teachers. Notice how when they came down and fell through the ice, what's the first thing they try to do? They come up and try to find the hole they fell through. Well, this bearish engulfing signal told us they failed. Where's our next likely target? Well, if they drowned, they're going to the bottom of the pond, meaning the next target is now down here at the 200-day moving average, which coincides with a bearish J-hook pattern. But if this is wave 1, wave 3 will be of that same magnitude. Knowing the specific signals and patterns, such as a bearish belt hold signal. Bearish belt hold signal is very easy to identify. They gap it way up out of the trading range and then basically bring it back down into the trading range. Today with the lower open, that told you this was a failure, especially of the 50-day moving average, as well as continuing the downtrend. That took out a lot of buyers, so that means there's not very many buyers in the way, making the next move to the downside extremely strong. Being able to analyze the individual commodities that may affect a sector, such as gold, we can see what gold was doing. After it broke out through this level, based upon this Morningstar type signal, notice today it actually used the T-line as support and did a left-right combo, indicating that if it opens positive, we're probably wave 1, wave 2, wave 3, or telling us gold prices are going higher. This makes analyzing the gold stocks very viable. So there are still good sectors to be buying even when the overall market may be heading lower. That'll be it. We'll see you in the chat rooms.